Hello, good morning or afternoon, depending on where you are. Today, we're going to discuss a topic that cuts across all different types of traders. But before we start, my name is Camilla. I'm Sales Executive here at PhillipCapital UK. If during the duration of the webinar you feel like asking questions or you want to make a comment, please feel free to do so. I'll be here and hopefully I'll catch your question and be able to answer live. Otherwise, you can also send an email to support@phillipcapitaluk.com. You can also see my email address on the bottom right corner. Feel free to email me at your best convenience. As I was saying, we're going to discuss a topic that cuts across all different types of traders, whether you're a scalper, long-term trader. It also cuts across preferred instrument types, whether you enjoy trading FX, CFDs, futures. This applies to you as well. But it also cuts across levels of experience and expertise. So whether you're a beginner or an experienced trader, this should be able to, help you and allow you to learn something new, because most traders do struggle with the topic we're going to discuss, which is trading psychology. Everyone deals with trading psychology in a different way, and anxieties that comes from trading psychology or from trading in general, and some do it better than others. The aim of today's webinar is to understand the pitfall and learn a couple of practical tips to master your emotions. Remember throughout the whole webinar that emotions stem from beliefs, but beliefs are merely patterns of thoughts that keep reoccurring in time. So what we can do as traders, as individual people, is to rewire those patterns of thoughts and really master trading psychology. We're going to go ahead and start. I'm afraid I have a little disclaimer for you. Trading leverage products involves risk and may not be suitable for every investor. Please consider these facts before making any investment decisions. The following webinar is for educational purposes only. It does not take into account your objectives and or your financial situation. So the examples we use are not recommendations or solicitations to trade, nor should they be taken as advice. Anyway, if you do want more information about PhillipCapital UK, you can find our business terms and conditions on our website. And I really urge you to go and visit it, because we're changing it and there's always announcements and news happening with PhillipCapital UK on there. So do go and visit it. PhillipCapital UK, I think I might just take you through our website directly. If you bear with me for a second. Here we go. PhillipCapital UK is a regulated FCA broker that stems from the group PhillipCapital, based in Singapore. The group was actually funded by Mr. Lim Hua Min, the executive chairman of the PhillipCapital group of companies in the 70s, so lots and lots of experience. Since then, the group has become a financial powerhouse globally, offering really a wide range of services, from insurance, banking, futures trading, so on and so forth. But the UK desk, here based in Cannon Street, right in the centre of London, is specialised in FX, CFDs and commodities trading. But the best way to understand about our product is obviously downloading our demo account. You can do so here. I hope you can all see what I'm doing. On our demo account it's very quick to download. It only takes a couple of minutes, and it's a true true reflection of our middle account, which is a 100 STP modeled account. And it will also give you the opportunity to trade for free on $50,000 of virtual funds, and hopefully practice everything that you will be learning in just a few moments. So to go back to our presentation, what is setting you back? The market is random. So understanding this is probably the key tenet to becoming profitable in reality. We have seen traders doing it all the time in terms of market prediction. So we've seen our traders using RSI, harmonic trading, point figure, classic breakout estimate, so on and so forth. Obviously, there are times that the market will indeed adhere to your analysis. And this will inevitably make you feel like you're in control of the situation. However, there are times when the market will completely override the key levels you have set. And why does this happen? But most importantly, should you stop analyzing the market? And this is really a theme that will be very pertinent throughout the whole webinar. What we're trying to get across is that one should really understand that the only reason that the market is moving because it's pushed by people, individual people, big and small players spread around the world. And in some cases, it only takes one trader with enough capital to completely override or invalidate your analysis. And a lot of traders think that they're trading against the market. However, the market does not care. It's not a person, it's not a thing. It simply, this is something that we really want to get you to think about. The market is not a thing. It's not a person, so you need to truly understand that you can't quite take revenge on. Obviously, the financial market is accessible globally, and since traders in the market, trades can be done by anyone, anywhere, it can be pushed left, right, and center by anyone. So let's say if you're a London market and you want to sell a position in gold CFDs because of fundamental reasons, you can do it by placing an order with your broker at a certain price. And that trade can be taken by a trader sitting in Sydney, representing a hedge fund, who believes your price is suitable for obviously him or her for whatever reason. And with that combination, the price moves. What I'm trying to say here is that anything can happen in the financial market for any reason. And it can sometimes be a complete surprise. So where does this leave you? We will never tell you not to perform some levels of analysis because, you know, I personally really truly believe in technical analysis. What we're trying to say to you is that you need to remove that emotional attachment and that idea that makes you think of what will the market do next. You need to believe that the market will and can do anything. And until you come to this realization, you will always cut profits short or get stopped out short of the breakout move because your analysis has told you that if X happens, that Y is just around the corner. So mastering your mind is really, really important for successful trading. And if we just move along, I wanted to discuss to you a major pitfall for some of our clients. And this is FOMO trading. FOMO is the acronym for fear of missing out. To paint the picture, our typical FOMO trader is usually very optimistic about almost any trade because I don't know, this trade looks amazing. There's something about the trade that looks better than the other. Or, we've all been there. If I miss this trade, there will not be the same opportunity. Looking at it from this perspective, it sounds a little bit silly because we can all recognize the fact that there will often be another opportunity. But in reality, FOMO trading affects the vast majority of retail traders at most levels. And unfortunately, most traders will not actually realize that they're experiencing it. And this is what makes this a lot more difficult to tackle. So why, you may ask, is it such an issue to experience FOMO trading? Well, first of all, it pushes you to trade every single trade, even if it's not a good trade. It can also cause and this is probably the worst side of FOMO trading, to increase your position sizes. Because if a particular trade happens to be the trade of the century, it would just be a pity to not go all in. But when this utopic trade turns into a losing trade, we see our traders with a lot of capital invested sitting on quite a substantial loss that will be not impossible, but really difficult to come back from. If you think that this sounds like you, or if there's bits of what I'm saying that resonates with your experience, then discipline is one of the most important virtues to implement. Think about it this way. The super famous businessman, Charlie Munger, was once discussing how they missed Google and Amazon at Warren and Buffett. They just didn't see the opportunity for whatever reason. In fact, Munger said, we will keep missing them. We will keep missing opportunities, investment opportunities. It's just the way things go. But the secret, and this is what I want to highlight, and I think there's so much value in this, is that you just need to try not to miss all of the opportunities. And really, really remember that missing trades is 100% part of the industry. If you do find that you are facing, as I was telling you before, FOMO symptoms, there are a couple of things that we do recommend our clients to do, clients that are in the same boat. Firstly, stay out of chat rooms, forums, Twitter, whatever it is that you enjoy doing in terms of social trading. Try to do that for 1 or 2 weeks. Trade alone in your own accord and follow your own trading strategies. Basically, it's all about detoxing, okay? It's about secluding yourself from possible triggers. So you go to a forum, everybody does this. Go to a forum and you see somebody mentioning how they just made X amount of money on, I don't know, cable position, and it was great, and there's still room to take some profits. This will inevitably trigger your fear of missing out. Social trading is not bad at all, you know. I'm not saying that you should avoid it completely, immediately. But if you are experiencing symptoms, then it may be worth to take a little time off. And let's say that you do take time off. You take, from Monday to Sunday, 1 week, no forums, nothing, but you're trying to come up with trading strategies, but you find that you can't quite do it. You can't quite generate trading ideas. This is probably an indication that you need to take a step back. Regroup, perhaps. Go back to your demo account. Always have a demo account whilst you have a live account. Have a conversation with your account managers. Here at PhillipCapital UK, we really put a lot of emphasis in having a steady and continuous relationship with your account managers, and try to increase your level of fundamental and technical analysis. Technical knowledge. This should really help you to recreate that foundation from which then you can build on with other things such as social trading and so on and so forth. I'm now going to talk to you a little bit about random reinforcement and revenge trading. So random reinforcement adds to the real psychological strain that some of our traders face and really struggle with. The idea behind random reinforcement is that you, let's take a step back. So positive reinforcement is the idea that you positively reward someone for good behavior and simply you punish them for bad behavior. So let's put it in a completely different context for a second, just to get you to really think about the importance of this. Let's say you have a dog and you want to train it to sit. What you would do is you would reward it for good behavior. You would give it a treat every time it responds to the command. And you would punish them by, let's say, not giving them a treat every time they don't respond to the command. And this sort of routine reinforces good behavior. So good treat, bad no treat. Simple. But what would happen if 9 out of 10, or let's say 7 out of 10 times that the dog does what you're telling it to do, 3 of those times you don't give it a treat? So when it was doing something good, it actually wasn't, the dog was not rewarded for their positive behavior. This is random reinforcement for you. The owner, in this case, is randomly responding to the dog's behavior with a positive or negative response. And the dog will be obviously unable to operate effectively because it's confused by the response of the owner. So let's bring it back to trading psychology and you. So you open the account, you deposit your capital, you've done it all. You've done the demo, you've spoken to your account manager, you've studied your fundamentals, your technical analysis, your, Fibonacci is indicator as your best friend. You know it all. You open the account, deposit your capital, begin placing live trades, and following your you constantly follow your strategy. You don't deviate, but after 5 trades, you still haven't had a successful one, and can't quite understand what went wrong. So you begin questioning the trading system and your approach to the market. And then one day you get really angry, or you're just scared you're going to miss out, just to link it to our previous slide, and you randomly place a trade, you profit considerably, or you profit, this is inevitably going to have an effect on your psychology, because now you're almost wiring yourself to think that to deviate from your strategies, to um, to sorry, you will start to deviate from your strategy because the market has positively rewarded you for something that you were doing. But you have to remember that the market isn't a thing. It isn't a person. It does not respond, or it does not care about you. So really do keep this in mind every time. Write it down on a post-it note, write down random reinforcement, put it on your display, and do try to stick to that plan. And if you think that losses are upsetting you to the point that you feel like you do need to take revenge, this is probably an indication that your position sizes are too large. So again, bring it back, trade smaller sizes, and stick to the logic that you have set up your pre-trading strategies. That we will discuss how to do that in just a few moments, but just again, stick with your logic, and remember that the key is making sure that your wins are more than your losses. So don't get so focused on that one loss or on those 5 losses. If you do have a plan, then stick to it. Do you even have a long-term plan? Are you looking at the bigger picture rather than attempting to make back the loss the very second you receive it? Because if you have a larger plan, then one loss is not going to disrupt you from a psychological perspective as much as it would if you didn't have a long-term plan. Also, do think about your plan once more, and try to really understand if your expectations are a little bit unrealistic, and if you're giving yourself high expectations rather than long term targets which are more realistic. So do review your targets if that is an issue for you. Gambler's fallacy. This is again a recurring pitfall or issue amongst our traders. And this is simply a misunderstanding of probabilities. So what is gambler's fallacy? It's sort of the erroneous belief that the onset of a certain random event is less likely to happen following an event or a series of events. And this line of thinking is obviously incorrect, because past events do not change the probability that certain events will occur in the future. If we strip it right down to the basics and consider, let's say, a series of 20 or 10 coin flips, and they've all landed with head side up. What do you think will be the 11th or the 21st coin flip? I can't see any responses, but if your tail is the answer you were going to tell me, you're probably falling into the gambler's fallacy trap. Because a lot of people under gambler's fallacy believe that the next coin flip, just because they've all been heads, is more likely to land with the tail side up. And this is an inaccurate understanding of probability, because the likelihood of a fair coin turning up or heads still remains 50-50 because each coin flip is an independent event. And obviously, all previous flips have no bearing on future flips. So some investors believe that they should liquidate a position, for example, after it has gone up in a series of subsequent trading sessions, because they don't believe that the position is likely to continue to go up. And conversely, other investors might hold on to a trade that has fallen in multiple sessions because they view a decline as maybe improbable. But you have to remember to exercise awareness. And if you're going to take anything from this slide, is to really trade each trade individually. Unfortunately, winning streaks don't exist in trading. And that euphoria is the issue. The euphoria that comes with a successful trade can really cloud your judgment just as much as a running loss. And you don't, sometimes our traders, they don't quite understand that. They think that trading psychology is almost your reaction to failure, but it really also is a reaction to wins. So don't let a big profit stop you from stick to your trading plan. And one more thing which I see here and I'm forgetting to mention is to to not fall into these traps. Note your trades. I'm going to discuss how to do that in a little bit, but you can download from your NT4 desktop a trading report. It's so simple, and a lot of our traders don't know how to do that. You can download it. You can see how many consecutive wins you've got, how many losses you've got, and it can really help you overcome these emotional issues that may cloud your judgment. Greed. So there's an old saying on Wall Street that says pigs get slaughtered. Pigs get fat and the hogs get slaughtered. Greed in investors causes them to hang on to winning position for too long, trying to get that very last stick. And this trade can be devastating to returns because the trader is always running the risk of getting wiped out or blown out of a position. And this is it's not easy to overcome because humans, with many of us, there seems to be an intrinsic and instinctive, emotion to always try to want to do better and to try and get just a little bit more. But a trader should really recognize this instinct if it's present and develop trade plans based on rational business decisions, not on what amounts to an emotional whim or potentially harmful instinct. At the end of the day, you are the final decision maker for your portfolio. We run an execution desk only, so really this is quite important. It's an important point to stress. You're the final decision maker of your portfolio, and thus you really are responsible for any gains or losses in your investment. So sticking to sound investment decisions while controlling your emotions, whether it be greed or fear, and not blindly following market sentiment, is crucial to successful investing and maintaining your long-term strategy. Software dependence. We have a lot of EA traders. We welcome this sort of strategy at PhillipCapital UK. And for those of you that are not so accustomed with it, automated trading softwares go by different names. You may have heard it as expert advisors, robotic trading, program trading, so on and so forth. And some do believe that EAs do relieve a little bit of the pressure that comes with psychological, that comes from trading. So relieve the psychological pressure of trading. But where they fall, where they struggle with, is that they need to remember that EA still need, you still need to know when to intervene and when not to. Which is where the psychological pressure kicks in. Let me tell you now, there is no holy grail of, a robot that you just slam into your MT4 and it will just make you a millionaire. This, in reality, it doesn't happen, and if it does, we just, in my experience, here in UK, I've never seen that happening. Remember that technology can definitely empower your trading, but only when combined with a good working knowledge of underlying trading concepts. And over reliance on software can cause more problems than it solves. So make sure you're really familiar with the market before you invest, even if you're using automated technology. And again, from my experience, the individuals, my clients who are successful with EAs, are constantly watching how their EA is performing. And they tend to know how to make adjustments as market conditions change. And obviously, they do also intervene when uncommon events occur. So do keep this in mind if you're thinking of using an EA. So over leveraging, I'm sure you've heard this before. Leverage is a double-edged sword. High risk, all or nothing environment mean that any slight mistake can wipe out your capital. So why is it that traders keep over leveraging? Traders get dazzled by the degree of leverage they possess, especially in forex trading. And high leverage works against the trader by increasing the stakes and making that euphoria that we were talking about, it would just make your heart beat faster. But unfortunately, mistakes will inevitably happen during trading because no one, unfortunately, is capable of predicting every movement of the market. So do not lose focus on your lessons, on all the lessons that you've learned, and start slowly. If you cannot, always ask yourself this question: if you cannot make great returns at a low leverage, what makes you think that you will on a high leverage? So do keep this in mind when choosing your risk appetite before a trade. We'll now discuss briefly about little preparation because we'll go over it in a second again. So greater preparation, traders should try to learn about their area of interest as much as possible. Let's just start by saying that. For example, if traders deal heavily and is interested in, let's say, oil, CFDs, or let's say commodities, it makes sense for him or her to become knowledgeable about that area. And similarly, if he or she trades heavily in, something else, another financial instrument, it's logical to want to become well versed in that area. But you need to remember that to do this, you need to start formulating a plan to educate yourself. Go to trading seminars and attend webinars, conferences. Really do try and submerge yourself as much as possible into this environment. And if it makes sense, plan out and devote as much time as possible to the research process. And this means studying charts, speaking with your account manager, reading trade journals, so on and so forth, so that when that trading session starts, you're up to speed. In addition, the more prepared you are, and this applies to various areas in your life, not just trading psychology, but ultimately, if you feel ready, then you will be less scared. And if you're not quite ready, then you will be more scared. And this is the same with trading psychology. Also, some would say do try and experiment a little bit. It could be either on a demo account, on a live trading account, but if you experiment a couple of things, a couple of instruments, and now you've got that out the way, then you will be more likely to focus on your area of interest. You should also periodically review and assess your performance. I will discuss this in more detail in a little bit, but try and review your returns and individual position before and after a trade. And this periodic assessment can help you correct mistakes, which may help enhance the overall return of your portfolio. And inevitably, it will help you maintain the right mindset and be psychologically prepared to, do business. So as we were discussing, I'm going to go through a few, just very briefly, best practices that may help you with your trading psychology. So best execution is not simply about measuring transaction costs and other relevant metrics. So after a trade has been executed, but best execution is a process whereby informed decisions are made throughout a trade's life cycle in order to achieve the best possible result for yourself. And clearly, a key stage in the trade life cycle is pre-trade assessment. What is worth noting before you begin trading or you're setting up your strategy? Number one, timing of trade. The impact on cost when looking at timing of trade can be very significant. Pre-trade analytics should allow a user to compare costs for different execution times over a given day. So, for example, on days with relatively low volatility and, let's say, little price direction, it may be beneficial to wait and execute during time of higher liquidity, obviously. So, timing of trade. Number two, sizing of trade. Before you come up with a strategy, there may be it's very important to determine the optimal size to trade. There may be a little bit of discretion here, but if there is flexibility for you, the sizing can add value because obviously costs will fluctuate by size. And you really have to think to yourself, how quickly can the market digest my risk? There's often a bit of a misconception that the FX market is so deep. I mean, it is, but the idea that the market is so deep and liquid should be considered, because we often see examples where relatively, sometimes small ticket sizes can create significant market impact and footprint. So do consider that when you think about sizing of trades. In fact, the market is generally liquid compared to other asset classes, but it's also very fragmented, with a lot of liquidity recycled across venues and providers. So one could argue that by declining risk appetite, you may see long-term profits rather than just constantly executing larger sizes. Pre-trade analysis on cost by size and also information prior execution of similar sizes to see what has worked well and what hasn't at different times of the day can be very, very valuable. So don't forget. So we've got timing of trade, sizing of trade, and defining the duration of your trade is very important. A common question when deciding the trade over a period of time is how long, particularly if the trade does not have a specific objective of tracking a particular benchmark. So if you have discretion over setting the duration, then pre-trade analysis can add value to you, as there are many conflicting sources at play. Obviously, if you trade too quickly, you may create unsatisfactory market impact, whilst minimizing the time that the market has to potentially move against you, defined as opportunity cost. And equally, if you trade too slowly, then you may minimize market impact, but you may run significant market risk, particularly in high volatility environments. And this could result in adverse opportunity costs for you. So do remember, before you start trading, to really consider timing of trade, sizing of trade, and defining the duration of your position. Post-trade assessment. You've done all the analysis, you've executed the trade, and now what? Well, in my view, in our view, the best practice should be such analysis is saved and stored for the specific trade. And when you go back into your post-trade analysis, how valuable, just think about it, how valuable could it be to have all the trades tagged with the associated pre-trade analysis you performed? This will inevitably allow you to compare performance on post-trade basis with the pre-trade analysis. So you could even have a look at your pre-trade analysis and have a look at your post-trade analysis and see, did choosing that particular, expert advisor or algo or indicated perform as expected? This feedback, we could say loop, this feedback loop is valuable because it allows the decision to be assessed and adjusted in the future. And all of this goes back to everything we've discussed before. The more prepared you are, the less likely you are to fall into that fear, or equally that euphoria that comes from winning a trade. So spending the time to perform pre-trade analysis and post-trade analysis, not just about ticking box. It's something that, unfortunately, you need to invest the time, but it is time that's well spent, because at the end of the day, it will add additional value to the whole execution process. Are you making the most of your account manager? Because if you do realize that you're struggling with trading psychology, or really in reality anything else, we're very happy. I mean, PhillipCapital UK has a dedicated team of account managers who are on hand to improve your trading experience. This is what a job entails, making sure that you're having a favorable trading experience. And our London-based team are available to answer any questions you may have, whether it's platform assistant or account information, how to get that MT4 report, how to download that MT4 account if you haven't already done so. So please do contact us on support at PhillipCapitalUK.com or .co.uk. You can also find us on 0207 398 3100. You can have a look at our blog on our website. We daily post announcements, fundamental and technical analysis for our clients. And you can also visit and share our YouTube page, where you will find previous webinars and interviews we've had, market analysis, so on and so forth. If you already have an account with us, if you don't have an account with us and you do feel ready, you can open a Phillip account with us. At the moment, we have a promotion which does not oblige you, or there is no restriction for a minimum deposit. Usually, our Phillip account, which is very competitive, starts from 1 pip in spread. I would be happy to discuss it with you later on. It requires a minimum $200 deposit, but for the next month, you can deposit as much as you deem appropriate, and you will be able to open an account with us and still take advantage of the same services of any other of our account holders. If you are an account holder, you should know that we have a loyalty program. So if you refer a friend, you can get rewarded for referring them to us. You can find out more about it on our website again. I hope this was helpful. In conclusion, let's say if we can wrap it up, psychology of trading should really be understood, as it may be what is holding you back from successful trading. Obviously, psychology of trading should be covered along with other pillars, such as methodology, in other words, the analysis and trading plan behind why you buy and sell, and money management. But it, as I said, it goes hand in hand with your approach to trading, and it should be really taken seriously. If you have any questions, do contact us. But thank you very much for joining us and listening. Have a lovely day.